Good day, everyone, and compliments of the season. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we discuss stability versus growth. Can the 2026 federal budget deliver both? On Friday, December 19, 2025, President Bola Tinubu presented the 2026 budget proposal to a joint session of the National Assembly. The proposed budget, titled Budget of Consolidation, Renewed Resilience and Shared Prosperity, is set to take effect on January 1, 2026. It aims to improve the business and investment environment, promote job-rich growth, reduce poverty, strengthen human capital, and protect the vulnerable. The budget figures are based on assumptions including a conservative crude oil benchmark of $64.85 per barrel, crude oil production of 1.84 million barrels per day, and an exchange rate of 1,400 naira to the US dollar. These assumptions appear more prudent and realistic than in previous years, aligning more closely with the recent production levels around 1.4 to 1.5 million barrels per day in late 2025 and ongoing FX reforms. The proposed 2026 budget expenditure is 58.18 trillion naira, including 15.52 trillion naira for debt servicing. Recurrent non-debt expenditure is 15.25 trillion naira, while capital expenditure stands at a substantial 26.08 trillion naira, representing about 45% of total expenditure, a marked improvement in priority over previous budgets. Projected revenue is 34.33 trillion naira, leading to a fiscal deficit of 23.85 trillion naira, 4.28% of the GDP. Revenue projections emphasize efficiency gains from non-oil sources driven by tax reforms, digitization of GOE remittances, and improved oil sector governance, thereby reducing historical over-reliance on volatile oil income. Drawing on 2025 performance with only 61% revenue realized and low capital releases of approximately 18% by Q3 2025, the proposal includes stronger execution measures such as directives to ensure timely implementation and to end overlapping budgets. Our view on the proposed budget. 1. The budget assumptions are more grounded and conservative than in previous years, with a lower oil production target reflecting recent actuals, e.g. 1.4 million barrels per day in November 2025, and security improvements in the Niger Delta. The exchange rate assumption supports stabilization, though parallel market pressures persist. 2. Recent economic indicators provide a positive backdrop. GDP growth at 3.98% in Q3 2025, up from prior quarters. Inflation moderating to 14.45% in November 2025 after 8 months of decline, and external reserves at a multi-year high. These gains, built on reforms, justify the focus on consolidation and translating stability into prosperity. Revenue of 34.3 trillion naira shifts towards non-oil dominance, about 2/3 projected, bolstered by new tax laws and GOE digitization, a welcome diversification move amid global energy transitions. 4. The fiscal deficit rises significantly to 23.85 trillion naira, which is 4.28% of GDP, exceeding the Fiscal Responsibilities Act 3% threshold and signaling heavy borrowing reliance. While addressed through disciplined financing, domestic and multilateral, this remains a risk if revenue underperforms as in 2025. 5. Debt servicing at 15.52 trillion naira consumes about 27% of expenditure and approximately 45% of revenue, highlighting the ongoing burden of past borrowing and potential crowding out of productive spending unless revenue mobilization accelerates. One key weakness in Nigeria's debt metrics is that GOE revenues are included in government revenue, but their debt service is excluded. This makes the federal government's debt service to revenue ratio appear more conservative than it truly is, understating the real public sector debt burden and associated fiscal risks. 6. The elevated capital expenditure at 26.08 trillion naira, which is 45% share, is commendable, prioritizing infrastructure, agriculture, and productivity. If executed with the promised accountability, it could drive job-rich growth unlike the low 2025 releases. 7. Key sectoral allocations. Defense and security at 5.4 trillion naira, reflecting intensified efforts against insecurity, including a new counter-terrorism doctrine. Infrastructure at 3.56 trillion naira, education at 3.52 trillion naira, approximately 6%, and health at 2.48 trillion naira, about 4 to 6%. The emphasis on security, human capital, and agro-value chains aligns with diversification and food security needs. 8. Initiatives like agricultural mechanization, input financing, and private sector-led projects could enhance resilience, while ending budget overlaps by March 2026 aims to restore fiscal discipline. Overall, the 2026 budget builds thoughtfully fully on 2025 partial gains and lessons, offering potential for sustained recovery if revenue targets are met, capital implementation improves markedly, and reforms persist. However, risks from security challenges, external shocks, and execution gaps could undermine outcomes. Strategic, transparent policy execution will be crucial to delivering shared prosperity. Please note that this is the federal government's budget and not the budget for the states. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions and comments, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 0708246347. Stay blessed and have a great week. Bye.